what I'm going to do in this last part of this lecture is talk about another factor that turns out to be extremely important in shaping global portfolios, which is the role of global tax havens. So these are jurisdictions like, for example, the Cayman Islands, right? Ireland, Bermuda, Panama, Switzerland, which maybe you've heard about in the news, maybe in academia, because of their role, in corporate tax avoidance or tax avoidance by wealthy individuals. Turns out that these same jurisdictions also are extremely important in how global corporations raise capital from worldwide investors. And so I think Jesse gave you a little bit of a flavor of this, but just to understand the magnitude of just how important tax havens are for global capital allocation, here this bar chart is plotting the size of the total gross assets and gross liabilities of countries around the world. So this is adding up everything. This is adding up the portfolio side, the FDI side, and so on. These are ranked. So obviously the US is by far the largest outlier here with massive gross financial positions. But then you can see that in the top 10, top 15 globally, actually it's probably not the countries that you would expect if you were just thinking about the size of their economies, right? But rather what you see is Luxembourg has gross liabilities of more than $10 trillion, gross assets of just a little bit under that. And we'll talk a lot more about actually the gap for Luxembourg specifically. And similarly, you see countries like the Cayman Islands, the Netherlands, Ireland, Hong Kong, Singapore, the British Virgin Islands, and so on. Clearly, these countries have very outsized financial positions, gross positions, relative to the size of the local economy. Another way of seeing it is if we look at the countries in the cross-section, this is looking at the latest year. Here on a logarithmic scale, so log, I'm plotting on the horizontal axis the GDP of countries, and then on the vertical axis is their gross assets and liabilities summed, the size of their total gross external position. And so the regular, what you might think of as industrial countries, these are in blue, and you can see they fall somewhat neatly along a regression line in this log space, like France, Germany, but even the US. The tax havens, which are in red here, are huge outliers in this graph, right? So the gross financial positions of these countries are many multiples the size of the local economy. And that's because these countries are intermediating capital flows. Actually, before I go ahead, let me just say, please interrupt me at any time, like jump in with questions, very welcome. So an example here is if you went and looked at the Treasury International Capital Data, TIC, which I think Jesse introduced you to this morning, you will see that 15% of all holdings of US investors of foreign stocks and bonds are in securities that are issued in the Cayman Islands. So it's more than 2 trillion in holdings just coming from the US alone in this tiny island nation, which has a GDP of $5 billion, right? This is like a 1,000-fold gap. And so it's clear that the capital is ultimately going somewhere else. Now, the big question that we care about in academia, but also in policy, is what do global exposures look like, right? So American investors, what are their exposures around the world through their portfolios? What are the financial linkages that connect countries around the world? And it turns out that because so much of these positions get booked in these tax havens, that heavily distorts our understanding of global capital allocation. And so to understand really the roles that these countries are playing and how all of this is happening is helpful to start with a concrete example. And so here I'm taking the case of Petrobras, which is the Brazilian state-owned oil giant, okay? So how does Petrobras raise capital from foreign investors in advanced economies, like investors in the US or investors in the Euro area, which here is EMU, European Monetary Union? So, if I had asked you this and you hadn't heard about all this work on tax havens, you might imagine, and that would be very reasonable, you might say, well, BMW is simply going to issue a bunch of bonds in Brazil. The American investors, the European investors are going to buy these bonds, and that's how this financing happens. Now, when we go and look in the data, and here I'm referring to the fund data and also microdata for other sectors, which I'll tell you about, which Jesse and Matteo also told you about. In practice, we see exactly zero of this financing activity. Petrobras actually does issue bonds in Brazil, but these bonds just do not end up in the portfolios of American investors or European investors. This is not to say that Petrobras is not getting capital from these investors. It's just that it's happening through the tax havens. So Petrobras instead has established a financing subsidiary called PIFCO, Petrobras International Finance, which is resident in the Cayman Islands. And so it's the bonds issued by PIFCO that get bought by the US investors or European investors. So we see more than $1 billion just in this type of holdings from each of the Americans and the European in the microdata. And then the capital might get channeled to the Brazilian parent, for example, through an intra-company loan. And actually, the structure gets even more complex because these global multinational firms don't have like just one financing affiliate in tax havens, but multiple. So Petrobras, for example, has two more up here in the Netherlands. Petrobras Global Finance and Petrobras Global Trading. They're resident in the Netherlands, and actually we see even more of those holdings. We see like 5 billion from American investors in the microdata, 6 billion from the European investors. Now, the key point is, I think Jesse already told you a little bit about the distinction between residency and nationality, and how sort of international statistics are normally compiled on a residency basis. So what that means is that if you go and look at official accounts, like the TIC data, like the CPIS data, on what investors own around the world, those are constructed on a residency basis, which means that these securities get associated, the position gets associated with the country and the sector of the immediate issuer. And so, for instance, all these flows that you see here will get recorded as Americans and Europeans financing the financial sector in the Cayman Islands, or financing the financial sector in the Netherlands. But really, for most analyses, as economists, we want to think of these as investments in the oil sector in Brazil. That's what we call a nationality view of international financial statistics. And so what I'm going to walk you through to start is some work from our QJ paper in the 2021 that essentially shows you how we use all this extensive microdata to generate a new version of these country-level international financial statistics that look through all this securities issuance happening in tax havens, and so are restated on what we call a nationality basis. And I think this also gives you a template for thinking about how do you sort of bridge, how do you go from microdata, which is not necessarily completely comprehensive, to the aggregate level. And so here there are 3 key data inputs on how we do these restatements to then understand how facts about global portfolio allocations change once we do this. So the first key data input is, of course, the official national statistics. So that's like TIC and CPIS. The second key piece here is what we had to do is construct a mapping that links each security issued worldwide, so each of these bonds, we're going to have to link them to the ultimate corporate parent and the corresponding country of nationality. Right? So this is the example of the Petrobras International Finance bonds issued in the Cayman Islands. We're going to link them to the ultimate corporate parent in Brazil. This turns out to be actually fairly involved to do if you want to do it systematically for all bonds and equities traded worldwide. And that's because these corporate structures actually sometimes have many layers, and you have to sort of carefully look through all of that. So the way that we tackle this problem is it's through an aggregation algorithm that resolves all these corporate ownership chains globally by combining together data from 7 commercial data sources. Actually, if you want to do this in your own work and you want to start doing this type of work sort of carefully in the microdata, and again, aggregate up to the ultimate parent level, which is also what Matteo was talking about in terms of doing the aggregation for the firm fixed effects in the work on currency that you saw. Our algorithm is actually up online. It's available publicly at globalcapitallocation.com. And the way it's constructed is it can be used with any subset of these inputs. And so actually you can get a lot of mileage even if you just go and see which data sets you already have access to through the library at your university. You can take those, run the algorithm on a subset of data, and you're going to be able to generate a mapping like this. So once we've constructed this mapping from the securities to the ultimate parents, now, of course, what we're interested in is holdings. And so we need data on the portfolios at the micro level. We want to know all of these investors globally, which securities are they holding? And so there we're combining microdata from 3 distinct data sources. The first one is the Morningstar data for mutual funds and ETFs, which Jesse and Matteo have already told you about. And so these show us the portfolios for this particular institutional sector, which is a very important sector for foreign investment in the US, in Europe, other developed countries like Canada, Great Britain, Australia, and so on. But we also use data on the complete securities holdings of the US insurance sector. These actually come from regulatory reports. These are Schedule D reports that US insurers file with the regulator, the National Association of Insurance Commissioners. And insurance companies are also very important, particularly on the bond side. So they're big fixed income investors. Plus, we're using here data on the securities holdings of the Norwegian Sovereign Wealth Fund. And so the approach that we take in this paper to go from this microdata to the aggregate country level is first we're going to see how the portfolios change once we merge this aggregation, security level aggregation, with the portfolios for these sectors that we cover. Now, of course, the microdata there doesn't cover everything that goes into the external portfolio. There's other institutional sectors and so on. And so to do these restatements at the country level, we do need to have, we need to make an imputation, right, an estimation, which relies on one key assumption. The key assumption here is we have to assume that the sectors that we see here, so the holdings that we see in the microdata, is representative of the broader universe of external portfolio investments for these countries, but not representative in general, right? Just in a weak way, in a very specific way, which is within each year, within asset class, within each bilateral country pair. So for example, what we are assuming here is that when the American funds and insurance companies go and buy corporate bonds in the Cayman Islands, what they buy looks similar to what all the other US investors buy when they go and buy corporate bonds in the Cayman Islands. And some of the validity of this assumption you can actually test, right, which is always a very good thing to do whenever you're doing this type of imputation and extrapolation. For example, we can look at how do the results change, right? If we use, for the US, just the funds data or the funds plus the insurers. Or for Norway, we can look at just the funds data versus the funds data plus the Norwegian Sovereign Wealth Fund, and so on. And overall, we're satisfied that this at least provides a major improvement over the official residency-based data. In practice, how this gets implemented is by constructing reallocation matrices. And these matrices, actually, you can go, if you go on our website, you can get them for all the investors, all the asset classes, all the years, and we keep updating them if you want to use them in your own research. So to understand what these matrices are doing, I'm showing you a sliver, just part of the reallocation matrix for US corporate bond investments. And this actually is for 2017, which corresponds sort of to the baseline year that we were using for the paper. If you go online, these are updated. Now we have also later years. So the rows of this reallocation matrix correspond to the destinations, right, where the US is investing on a residency basis. And then the columns tell me out of all the investments in this particular destination on a residency basis, how do I have to reallocate that to all the other countries on a nationality basis? So let's take an example. The row that corresponds to the Cayman Islands. Entry here for Brazil, that tells me 20% of US corporate bond investments in the Cayman Islands should get reallocated to Brazil, right, on a nationality basis. 33% should go to China. Then if you look at the diagonal element in the matrix, that's a share that stays in the Cayman Islands. You can see it's tiny, right? It's 1.4%. Why? Well, that's because, again, all these positions are not financing the local economy in the Cayman Islands. And so the vast majority we're going to reallocate away. And of course, if you sum across all the columns, each of the rows is going to sum to 100%. So we construct these matrices based on the microdata. And then to do the aggregate restatement, we take the vector of positions that comes from the official accounts. Yes?
Sorry, just a clarification on the previous slide. Rest of the world is unallocated or?
No. So if you actually go and look at the matrices, for example, online, there's no rest of the world, right? You'll see every single country. Here, just because I need to show it to you in a compressed way, everything that is not these 6 countries that I'm reporting on the columns, I'm just lumping it together and calling it rest of the world. But of course, from the microdata, we're going to be able to construct it country by country. There's no residual category here. Okay, so we're going to get the vector of bilateral positions. Here I'm showing you the restatements for US corporate bonds, again, for the 2017 baseline year. This comes from TIC, right? So TIC tells me what are the positions of the US on a residency basis. If I want to restate it, now that I have the reallocation matrices, all that I need to do is I need to take this vector, multiply it by the reallocation matrix, and the output of that is going to be another vector of positions, which are now restated. They reallocate all these investments in tax havens. And here, I'm giving you 2 different versions of these estimates. The first one that I'm calling tax haven only reallocates the investments, the securities issued in tax havens. Full nationality reallocates everything, including, for example, securities that foreign firms issue in the US. So I don't know if Jesse mentioned it, but this will be the example of like Toyota North America, right? Toyota, obviously, the parent is Japanese, but it has local operations in the US. The local company in the US issues bonds. For some applications, you might want to link those to Japan. For some other applications, maybe not so clear. Really, tax haven investments are the ones that we know we definitely want to reallocate. And that's why we focus a lot on this tax haven only column. So what comes out of these restatements? Well, actually, the pattern of capital allocation here changes really quite drastically. Look, for example, at what happens to the large emerging markets. So if you go and look in TIC, official residency-based data, the US only owns $8 billion in Brazilian corporate bonds, which actually seems very small. In fact, this has been puzzling to economists because these are large, fast-growing countries. It's always been a bit of a puzzle why we see so little investment if we just go and look in the data from all the advanced economy investors in these very large emerging markets. Well, the investment is actually happening, it's happening through the tax havens, right? So tax haven only restatement, you can see the position goes up by 42 billion. So we are up all the way at $50 billion, which really is our estimate of the true exposure of American investors to Brazilian corporate bonds. Similarly, if you look at China, this is a drastic increase, right? Official position is 3 billion. We're going up by orders of magnitude here, 47 billion. A lot of these bonds are issued in the Cayman Islands and in the British Virgin Islands. In fact, for some of the emerging markets, virtually all of the portfolio financing that they get from advanced economy investors is through tax havens. They're entirely reliant on it. Russia is a great example here. You go and look at the official data, it's 0. On a residency basis, it goes up to 12 billion, right? On a tax haven only nationality basis. Where are these positions coming out from? Obviously, wealth is not getting created or destroyed in the process of these restatements. It's just getting reshuffled bilaterally. And so, of course, it's coming out of the tax havens themselves. There you can see these positions plummeting. So the position in Cayman Islands bonds, it's going from 80 billion basically to zero, right? There's a little bit of a residual, which is we rounded up to 1 billion, but it's basically zero. And similarly, the positions in Bermuda, in Ireland, in Luxembourg, these are all falling dramatically. And this is not something that is specific to the US. If we look at the cross-section of investor countries, here you see exactly the same phenomenon. So this bar chart is showing you the share of the external bond portfolio that is in these large emerging markets. So in Brazil, Russia, India, China, South Africa. We're calling them the BRICS countries. For the US, you know, residency-based official data will tell you just a little bit over half of 2%, over 2% of the bonds that the US buys externally, buys abroad, are in these large emerging markets, goes up all the way to 7% or so. And again, this is across the board.
If you go back to the previous figure, in the introduction of this, you had the Netherlands listed as among these tax havens. What would its percentage be if it was included in this table?
What would, the Netherlands entry here. Yeah, you will see it also falling. There's a bit more of a residual in the Netherlands just because the Netherlands has actual also economic activity taking place there. So it's interesting. Actually, the European countries, Luxembourg, Ireland, Netherlands, are interesting in that, yes, they are tax havens, but also there's lots of companies operating there. And so you're not going to see the positions going all the way to zero. You are going to see these sharp reductions, however.
But it's closer to Ireland than Luxembourg.
It's going to, yes, exactly. Yeah, exactly. So Ireland precisely is a very nice example here where you see, most of it gets reallocated, but there is some, of course, local activity. I mean, Ireland has firms and, these patterns are actually even more striking if we look on the equity side. And I'm going to spend a lot of time talking about this. So here I want to highlight, so again, I'm doing the exact same exercise, but now I'm looking at the US external equity portfolio. Red column is again tick, and I'm giving you the restatements. I want to highlight two patterns here. So first, look at what's happening with Ireland. Official data, there's 385 billion of US investment in Ireland. This goes down by about 300 billion. So where do you think that is going? Well, actually, most of it is going back domestically to the US. The reason for this is that a bunch of US multinational firms perform what is called a tax inversion to Ireland. And this is for tax reasons, right? So it's a form of corporate tax avoidance. You'll hear a lot more about this, corporate tax avoidance and corporate profit shifting, by Gabriel Zachman when he presents tomorrow. So these are companies like, for example, Medtronic, pharmaceutical company in the US. What they've done is they shift their headquarters to Ireland. They're subject to the lower corporate tax rate there. And then in the official statistics, the investments, when Americans go and buy Medtronic stock, it's not going to be considered a domestic investment anymore. Rather, it's going to be considered an equity investment in Ireland. In fact, it shows up as foreign investment in the data, but really it's a spurious component of foreign investment. It also distorts our understanding of the degree of the magnitude and scale of financial globalization. The other really striking entry here, though, is China. Yes, Oliver.
Sorry, how do we think about like the repatriating the profits? Because eventually it has to go back to like the US, the US equity holder.
Yeah, so I think Gabriel is going to talk a lot more about it. The same problem of repatriation of profits also shows up in other contexts, like for example, when Apple shifts profits to Ireland, which it does in different ways. It's not through a corporate tax inversion. There's other ways to do profit shifting, which have to do with transfer pricing, right, and essentially shifting of ownership of intangible capital through cost-sharing agreements that are put on early on in the firm life cycle. What ends up happening is you book the profits in Ireland, And now you have to wait for something like a tax holiday, which occasionally happens to incentivize the companies to bring the cash back. You know, the US government occasionally is going to give them a very low tax rate for bringing the profits back. And that's why you see this big, it's part of the reason why you see these sort of giant piles of cash sitting in the Irish subsidiaries of American companies. Part of it is waiting for these tax holidays.
And so are these tax holidays still going to happen going forward, or is it kind of a remnant of the past?
So I don't think anybody can answer that question. You know, these are not things that are planned or, and again, we can also talk about it more, and Gabriel is going to cover all of this tomorrow. Okay, so if you go and look at TIC, official position, you will see that American investors only have an exposure of 150 billion to Chinese equities, which actually is very, very small if you think about the size of China in terms of market cap. People had lamented this and thought, why is the US so underweight China, which is a massive market and very rapidly growing? Well, it turns out that the exposure, once you account for all the issuance that the Chinese firms do in tax havens, goes up by more than $500 billion, right? So this was 2017. The numbers got even larger in later years. So the exposure to China goes up all the way to 700 billion. Why is this happening? It's happening because all the investments in equities of Chinese firms actually happen through the Cayman Islands. And you can see a very similar, in fact, the delta is almost identical if you look at the Cayman Islands, because this is for the most part actually investments in Chinese firms. And so in just a few slides, I'll explain exactly the nature of these structures and why Chinese firms are doing this. But again, across countries, you see exactly this very striking pattern in terms of much larger exposures of developed market investors to China. Residency-based data, the red bar will tell you that only 2% of the US external equity portfolio is in China. Once you account for this missing $1 trillion of investment in Chinese equities, goes up all the way to 10%. And similarly for Australia, for Canada, for Switzerland, and so on. Here, I'm showing you the same thing in the time series. So this is changing not just the level of the exposure of American investors to China, but also the trend. And so the blue line here is the residency-based position, again, in terms of the share of the US external portfolio that is invested in China. It's at 2%, but also very flat over time, which is puzzling given how quickly China has grown. Well, and that's because if you account for it, looking through the tax havens, you do see that very sharp increase. So that's the dashed red line here. And so you end up, actually, this is extended all the way to 2020. It goes up all the way to something like 14%. In fact, this is even more pronounced if you look at a different notion of exposure. So, you know, this residency-based is one way of looking at the portfolios. Nationality-based, a different way, which we think is more useful for many economic applications. But you might also say, oh, well, wait a second. What if my ownership of securities of one particular firm, I don't want to assign it just to one country, but rather I want to split it up across countries according to some notion that might be, for example, how their geographical sales are distributed. And so that's what this dotted green line over here does. It's a sales-based reallocation, which we've constructed, and again, is also available in terms of data if you go on our website. We've constructed using data from FactSet, which very nicely does this at the firm level. And so it gives you the geographical revenue distribution for firms. You can see it's way higher. So it goes all the way up to 20%, in fact. And that's because of all the firms that are not Chinese, but actually sell to China. So for example, in this sales-based restatement here, if you have an American firm and 25% of the sales are to China, so 25% of the ownership in that firm, in an investor's portfolio, we're going to consider an exposure to China. Why is this helpful? Well, it might be helpful, for example, if you want to think about exposures to final demand as a source of risk. And in fact, I think there's a very nice research question that is open here, which is thinking about theoretical models that jointly look at the trade side and the finance side, where I think some notion of a sales-based exposure is going to be a very important moment, a very important theoretical object. So actually, I will be very interested in seeing research on that. Okay, so now, why are the Chinese firms doing this? What is the nature of these Chinese equity-like structures that get issued in the Cayman Islands? It turns out, and this is very interesting, this is one more reason why the firms go and issue in these tax havens. In the case of China, it turns out to be about getting around a form of capital controls that the Chinese government imposes on these firms. Other firms like Petrobras do it also for a collection of other reasons. For example, in the case of Petrobras, Matteo talked about it a little bit. But part of it is about accessing a different investor base. Part of it is about taking advantage of a more favorable withholding tax regime and regulatory environment. For the Chinese firms, we know it's squarely about capital controls. So let me explain. The Chinese government has regulation that says foreign citizens actually are not allowed to have equity ownership in Chinese firms that are in strategically important industries, which includes the technology industry. And so, for example, large Chinese tech firms, like say Alibaba or Tencent, under Chinese law actually cannot have foreign shareholders. Now, you might stop me here and say, well, wait a second, Antonio, I know that if I just open up my brokerage account right now, I can go and buy, Alibaba stock on the New York Stock Exchange. But you just told me that that cannot be the case. So that's precisely the point. It's because what you're buying, if you go on the New York Stock Exchange, is not actually the Alibaba that is onshore. To understand what that structure is actually doing, contrast with a standard equity structure, right? So if Alibaba were issuing equity regularly, what you will have is just the operating company inside China, Alibaba, will get listed on a stock exchange. Chinese shareholders can buy it, foreign shareholders can buy it, end of the story. To get around the capital controls, what happens instead is Alibaba raises the equity capital through a variable interest entity, VIE structure, which works as follows. So you still have the operating company, Alibaba, in China, and it has its own Chinese owners. Now, Alibaba sets up a completely unrelated company, which is also called Alibaba, in the Cayman Islands, and that's the listed company. So this is the company that gets listed on the New York Stock Exchange and that you as the foreign shareholders can go and buy and hold in your 401k or in your brokerage account. How do the two companies, the operating company and the listed company, get connected? So the listed company owns, so fully owns, a subsidiary in China, which is called a WFOE, a wholly foreign-owned enterprise. It's not in a strategically important industry, so it's allowed to have foreign ownership. And in fact, often, the listed company might own the WFOE through a series of special purpose vehicles, most often in Hong Kong or in the British Virgin Islands. Now, the WFOE gets connected to the operating company through a series of bilateral contracts, which replicate the cash flows from equity ownership without entailing outright ownership. So basically, what happens? There's many versions of this, but in very simple terms, for example, Alibaba, the operating company, is going to sign over power of attorney to the WFOE, and also it's going to hire the WFOE as a consultant and pay 100% of its profits as the consulting fee to the WFOE. Okay, and so now, under international accounting standards, the listed company is allowed to consolidate the financials of the WOFE with the parent, and so it can tell the foreign shareholders that they have equity in the company because they're getting the cash flows, they're getting the dividends. On the other hand, the operating company can turn around and represent to the Chinese regulator that there are no foreign shareholders, right? Because in a very literal sense, there aren't. And so that is why the Chinese firms are going to the Cayman Islands to issue these equities. And it's not just one or two firms, it's all the major Chinese tech firms do this. So Alibaba, Tencent, JD.com, Baidu.
So this is all technically illegal in some sense in China. So if China
Yes,
decides to enforce this, what happens?
Yeah, so this obviously entails a lot of risk for the foreign investors, which I think a lot of foreign investors who own these companies actually don't, in fact, understand. And that's because the Chinese courts, this respects the letter of the law while violating the spirit of the law. And so it's entirely possible that if the Chinese courts and government decide to do so, they might just void these contracts and say these are just not legal under our interpretation of the law. And then what happens in that case? Well, the listed company now is a claim on nothing, and the value goes to zero. I mean, in fact, this whole issue of exposures to China has been big in the policy debate. A few years back, the administration even was weighing proposals about potentially delisting Chinese companies listed on US stock exchanges. I mean, in that case, it wasn't about the VIEs per se, but it was about them not conforming to transparency and accounting standards. But I think that the scale of the exposure was just very much underappreciated. Now, we're by no means the first ones to point out that these VIEs exist. There's a legal scholarship. But really what we pointed out in the paper is that the scale of the exposure is much larger than you would have thought. Now there's actually another bipartisan initiative of Congress. It's called the Ticker Act, which essentially will mandate very explicit risk warning labels when these VIE products are sold to retail investors in the US. Okay, why am I telling you all of this? I mean, A, it's interesting and it gives you insight in why the firms are doing it, but also it turns out that it has very important implications for how we think about China's net foreign asset position. So Jesse already told you a little bit about the net foreign asset position, which is a very central moment that we care about in international finance and international macro. So the NFA tells you how much of a net creditor a country is with respect to the rest of the world. And so the NFA is the difference between a country's external assets, A, and liabilities, L. And so as Jesse explained to you, the change in the NFA, right, this is the equation for its dynamics. The change in the NFA is equal to the current account plus valuation changes. So if the market value of the assets or the liabilities fluctuates, then that gets reflected in the NFA through the valuation changes term. What happens in the case of China is that these VIE structures cause an understatement of the liabilities, and that's because these big Chinese tech firms that raise capital through the VIE structures have had a massive run-up in price. And so, in principle, you should have seen those valuation changes show up in the L for China. But the VIE structure makes it so that the valuation changes do not go into the L. So the L gets disconnected from the actual market value of the companies. So think about it like this. If you had a standard structure, right? If the value of Alibaba fluctuates in the stock market, the liabilities get immediately revalued at the new market price, right? And so the value goes up. China has bigger foreign liabilities. And in fact, the liabilities, in this case, enter as portfolio equity liabilities. With the VIE structure, you don't have this portfolio equity liability anymore. Rather, you have all these contracts. And here I've shown you like one or two, but in practice, there's literally like hundreds. The structures get extremely complicated. They don't enter the balance of payments of China as portfolio equity liabilities anymore. In fact, they enter as FDI liabilities. And it becomes extremely hard for the Chinese statisticians to now link the value of all these many, FDI positions that are entering China to the value of the listed company in the Cayman Islands. Even if they were, even if they were trying their best, it gets so enormously complex that in practice, what happens is these FDI liabilities just stay a book value. The book value is ascribed when these structures are initially put in place. And that's why you have these valuation changes that end up being omitted from the liabilities of China. So a way to sort of identify this, to see the fact that these valuation changes are missing, is by focusing on one particular period, which is 2016 Q4 to 2018 Q1, which is when you had this massive run-up in price of all these companies. So the market cap of these VIE-listed Chinese companies increased by more than $1 trillion just during this period. So that's the red bar here. And so then we can go and ask, well, do we see this increase during this period reflected in any component of China's liability accounts? Now, the component where they should be is FDI. Okay, and in fact, really, it's FDI liabilities coming from Hong Kong, the British Virgin Islands, or the Cayman Islands, which are the points of entry, right, where the SPVs or the operating company are coming in to own the WOFE. In fact, these are going down during this period. FDI liabilities, barely moving. FDI equity liabilities, barely moving. If you look at other liability categories for China, which, you might think, okay, maybe for some reason they're getting booked in some other account, there's nothing that's nearly of this magnitude. So it's sort of just this sort of prima facie evidence that these valuation changes are missing. So once we, aggregate it up and think about what difference does it make for our understanding of China's net foreign asset positions, it's huge. Because, so the dashed black line here is China's officially reported net foreign asset positions. You can see by 2018, this was around 15% of GDP, or a bit over 2 trillion. Actually, in levels, so in dollar terms, this is one of the largest NFA positions in the entire world. The top three in official terms are Germany, Japan, and China. Once you account for the missing valuation changes on the liability side, the NFA shrinks by about 50%, right? So it's about a 1 trillion difference. Why does this matter? Well, this matters because of all the debate on global imbalances. In academia, but also in policy, there had been for a long time this question about China being a giant net creditor to the world and how this will get resolved sort of as we converge to a steady state. What will the adjustment process look like? And really, the adjustment process took place in large part already, just that we didn't see it because of the nature of these offshore financing structures and how they entered Chinese accounts.
Is this adjustment just for the equities, or is it also for the bonds?
This is just for the equities.
So it could be even larger if you took into account.
Yes. So in fact, on the debt side, I'll mention this because it's interesting. On the debt side, there's something that's a very good question. It's there's something that's very much analogous, which is, in international macro, traditionally there's been this idea, which is FDI flows are, stable. And portfolio flows are hot money. Why? Because the portfolio flows, I can liquidate them immediately. FDI, in principle, should be like investment in local plants and right assets that are much harder to liquidate, and that foreign investors are going to hold for a long time. Now, because of all these offshore financing that's happening, even not in the Chinese case, but even, for example, in the case of Brazil, the Petrobras example that I gave you, that the offshore financing, so it transforms portfolio debt flows into FDI flows. Because, go back to that sort of Petrobras example that I gave you. Now, when the US investors own the bonds in the Cayman Islands issued by Petrobras International Finance, that's a portfolio debt investment. But then if the funds get sent, so if the funds get remitted to Brazil, through an intercompany loan, that's actually going to show up as an FDI debt position, which in fact we hypothesized, although again, this is like an open question. I haven't seen sort of, proof of this, but we hypothesized that those FDI debt liabilities of Brazil now also get disconnected just from the value of the debt. So actually, this is a more general phenomenon. And again, it also really muddies up this distinction between portfolio flows and FDI flows globally. And it flies in the face of this idea that the FDI flows are of a very different nature and more sort of dynamically stable than the portfolio flows. Okay, we still have plenty of time. We have 25 minutes. So let me walk you through a few more aspects of this. So first, you might ask, well, okay, now if we take it to the aggregate picture, how important are these offshore markets for Chinese firms as a whole, if you also compare them to the onshore markets? Turns out they're extremely important. It's basically, the offshore markets is the first order element if you want to think about China opening up to the US, to other Western economies, and how it's been sourcing capital from them. So this plot here shows you in the time series the amount of foreign held, this is by funds, foreign held Chinese securities, equities and bonds split up by residency of the securities. So the gray area here is the securities issued onshore in China. You can see it's really relatively small. And that's not because China has like an underdeveloped domestic capital market. In fact, if you think about the Chinese domestic onshore bond market, it's by now the second largest in the world. It's a 20 trillion market. It's just that it's been very much closed off to foreign investors. So foreign investors only account for like 3 or 4%, for instance, of the Chinese domestic bond market, even though that's been increasing and China is also opening up the onshore markets. But that's sort of a topic for another day. Conversely, you might say, well, if we think about all this corporate financing that happens in tax havens, how much of that is accounted for by China? And that has just been skyrocketing, which I think is very interesting because, probably before this lecture, if I had mentioned tax havens to you, what might have come to mind is, rich Europeans, rich Americans, or the American firms doing tax inversions, not necessarily the emerging market firms or China per se. But in fact, if you look at the share of tax haven issued equities that are by Chinese firms, it was very little back in 2002. Now we're all the way up to 60%. Similarly, this major trend from 0 all the way to 20 keeps going up in terms of how prominent Chinese firms are in the offshore bond markets. And so China is just becoming absolutely dominant in these markets. Okay, so I focused a lot on tax havens as sort of a destination of the investments, but actually they also play a major role as a source of investment. And so the best example here is Luxembourg and Ireland. So this goes back to the work that we have recently released jointly with the European Central Bank, also with Angus, who's here in the audience, where now we're understanding this other side of the equation. So it turns out that a lot of times, particularly for European investors, but really also for investors in the rest of the world, when you go and buy foreign securities, you might do it through investment vehicles that are domiciled, that are resident in these financial centers. So this is a second role that these financial centers play in global capital allocation. For instance, when Italian investors or French investors or German investors want to buy US Treasury securities, most likely they're not going to buy those Treasury securities directly, but rather what they're going to do is they're going to go and buy a share in an investment fund in Luxembourg or in Ireland, which then holds the Treasury securities on their behalf.
So if you're gonna attach a currency denomination to those shares, what is it gonna be? Given that it holds U.S. Treasuries in the
Yeah, no, so that's a great question. Fund shares, fund shares do have currency of denomination, often particularly for fixed income fund shares. We haven't looked at it systematically. In fact, one question that we have is if you want to think about the sort of net currency exposures of the euro area as a whole, this is going to have a very important aspect, and that's because, as I will explain, a lot of the foreign currency holdings and foreign holdings that these Luxembourg and Ireland funds have actually are not euro area investors. It's investors from the rest of the world that are going there. And because they're biased towards like non-euro, if there is no corresponding adjustment on the liability side, which is sort of what you have in mind, that will have an important impact on the net currency exposures of the euro area as a whole. We haven't sort of systematically looked at, right, do the shares that hold predominantly dollar-denominated securities, do they report in dollars and they're dollar-denominated on the liability side? Presumably yes, but I don't have a number. It does turn out that in international accounts, the fund share liabilities actually don't get reported as, if I'm Italy, I hold a share in a Luxembourg and Ireland fund, that actually doesn't count, even if it's a fund that only holds bonds, it doesn't count as a debt investment, a portfolio debt investment. In fact, it always shows up as a portfolio equity asset. And so you might have a fund that just holds treasuries or just holds other types of bonds. The Italians hold it, it shows up as an equity investment. And so that actually also distorts your understanding on top of currency of just the asset class composition of the foreign portfolio. Okay, so this is massive. So Luxembourg and Ireland funds by now about 8 trillion euros that they manage. It's a big chunk of literally total global portfolio assets. And in fact, for euro area countries, 40%, so nearly half of all their cross-border bond and equity positions gets intermediated through investment funds in Luxembourg and Ireland. And so, if you want to answer questions like, what do the portfolio exposures of Italy looks like, or Germany, you're going to get a massively distorted picture if you look at the official accounts. And now it's not because of the residency nationality issue on the security issuance side, but just because of this intermediation through the Luxembourg and Ireland funds. The assets get counted as assets of Luxembourg, assets of Ireland. And that's this paper that we have joined with the European Central Bank is precisely about looking through also this side, looking through the intermediation in the investment funds and restating the financial exposures of euro area countries and of the rest of the world to properly account for all of this. This actually all gets even more complicated because, you might think, if you have the investment fund in Luxembourg and it's issuing a share to the foreign investors, well, I should be able to track that share in the asset side data for the other countries, right? Like, gets sold to the UK, I should see the UK report a fund share asset. It gets sold to Italy, I should see a fund share asset on the Italian sort of asset accounts. It turns out that nearly half of these fund share liabilities of Luxembourg and Ireland have just no identifiable owners in international financial accounts. Which you might say is a bit crazy, right? Because for any given external liability, globally, there should be a corresponding asset. And the corollary of that is that net foreign asset positions should add up to zero at the world level. In fact, that is not at all what happens. It's much more complicated, which is usually the case in international finance. And so this is something that Gabriel Zachman in his 2013 QJE paper pointed out and examined in detail. So the world turns out to have more liabilities than assets. So the world is a net debtor if you look at international accounts. This is just showing you the portfolio side, and you can see the liabilities being much higher than the asset. Again, if we add up everything globally. In fact, the gap has been growing even larger. This was sort of back in 2008, which is the year that Gabriel studied. If you look now, even bigger. This phenomenon of assets going missing is not really generalized and just sort of like spread across all countries, but it's really something that is specific to tax havens. And this matters a lot, right? This matters a lot because how then you assign these assets, which have no readily identifiable owners in international financial statistics, that's going to change your view of who's a net debtor, who's a net creditor. So actually the point of the QJE paper by Gabriel was precisely saying, if you take all these missing assets, which we know should be there, and you assign them to the Europeans or you assign them to the Americans, actually you're going to conclude that they're not net debtors as you would if you just look at their official NFA position, but actually they're net creditors. Which is just to say, we're trying to figure out exactly how those assets should be allocated, but it's hugely important in how we think about global positions. The fact that these gaps are concentrated for the tax havens, you can see on this graph, again from Gabriel's QJE paper. So this for each country, what it's doing is it's taking the total securities liabilities of that country and then subtracting from that the claims that all other countries make towards that country on the asset side. And you can see that the big outliers are Luxembourg, Ireland, as well as the Cayman Islands. Right? So for Luxembourg has this was back more than 10 years ago. It's even larger now. Back 10 years ago, it had $1 trillion in liabilities that nobody claimed globally. So how do you resolve this? Well, the approach that we've taken in this new work is we are looking very carefully at the microdata. So we're looking at each, if you go to the European Central Bank, they're going to tell you these are the complete securities holdings for each investment sector in each Euro area country. And I know which funds the Europeans are actually holding. So then you can link that to the commercial data on the funds portfolios, like the Morningstar data that we've covered today. And so now I can attribute the holdings that the Luxembourg and Ireland funds have to the investors in the funds and split up the wealth in that way. Okay, so this is using that methodology, which combines administrative data and commercial data to split up the assets of funds in Luxembourg, in Ireland, and also Germany, where Germany here, I'm just including it as a point of comparison. Actually, the first thing that you see from the graphs is just how huge Luxembourg and Ireland are. As I told you, it's almost 8 trillion euros. They overwhelm even the size of the German domestic fund sector. And then these colored areas are using our methodology to decompose the assets according to who the investors are. So the blue areas here are domestic investors in the funds. The red areas are investors in the rest of the Euro area. The green areas are investors outside of the Euro area, so in the rest of the world. And I want to emphasize that here the rest of the world on the investor side is constructed as a residual category. And so it includes known foreign positions, but also unknown positions, which constitute missing wealth in international financial accounts. And the paper sort of dives deeply into then thinking about what can we say and what can we not say about these unknown positions. Could they be Euro area residents in disguise? To do that, we bring to the table also new administrative data that we got from the regulators in Luxembourg and Ireland, which tells you how the liabilities get distributed on an immediate basis to all other countries. The very nice thing that you can do with this methodology is we can also look at how the various investors sort into buying different assets through these funds. And it's actually very striking. Here, it's particularly striking if you look at it on the currency side. So here, we're focusing just on the bond assets of these funds. And so I am taking each of these colored regions and I'm splitting it into 3 different shades according to the currency of denomination of the bonds. So the lightest shades are euro-denominated bonds, medium is US dollar bonds, the darkest is bonds in all other non-euro currencies, including, for example, the British pound. And so what you find is a lot of heterogeneity. So, for example, the lion's share of what the Europeans buy through all these funds is euro-denominated. That's certainly true if you go and look at German funds, where, by the way, it's really only German investors, almost all euros, but also if you look at what the Europeans buy through the Luxembourg and Ireland funds, right? For example, this light red shade over here. In contrast, the ROW investors, so the non-Euro area investors, when they go and buy securities through these funds, tilt heavily towards the dollar as well as other non-Euro currencies. For example, in Ireland, on top of the dollar, also the British pound is particularly important for the ROW holdings. The same is true if you look at the destination of these securities. So the ROW investors are going to tilt heavily towards securities outside of the euro area as opposed to the euro area investors. So these biases in terms of currency, but also in terms of destination, now are going to have very important implications once we think about it at the aggregate level. For example, let's say we want to think about what is actually the gross external position of the euro area as a whole, which is one way, a common way, in which we might sort of conceptualize the financial integration, the extent of financial integration of Europe with the rest of the world. Well, because the ROW investors have such a large presence in these funds, and they are very globally diversified as compared to the euro area investors, a big chunk of what gets counted in the official data as euro area holdings of foreign securities is actually spurious. If we remove that spurious component, what we get is a near 50% drop in euro area holdings of both foreign equities and foreign bonds. So you can see it's like a $2 trillion gap in each of these 2 categories. So overall, the gross external position of the euro area is shrinking dramatically. It's halving. It's going from 16 trillion all the way down to 8 trillion. And the composition of the portfolio is also changing fairly drastically. So you get much larger exposures in relative terms for the euro area as a whole towards euro-denominated assets and towards domestic assets, which means much higher degrees of home bias and home currency bias as a whole. And so this really is one example to show you that even these sort of very basic facts about external adjustment, in this case of the euro area vis-a-vis the rest of the world, or financial integration, we actually, even in a very descriptive sense, there's so much room to improve relative to what we know and what you can glean from the official data, which I think is actually what's been very exciting about this field. There's so much low-hanging fruit. I mean, partly because all this data, all this microdata that we're using to do these restatements and remap exposures has sort of just been coming online. And, I think there's plenty of work to do that's on these topics. Okay, so last 5-7 minutes of the presentation, I just want to give you, I always think it's very helpful when teaching, sort of PhD students like you to think about, okay, what are the open questions that you might want to tackle in your own research, how you might want to go about this. So I want to give you a little bit of a user's guide, just to walk you through the kind of data that you can get from our website, the GCAP website, and which we continue updating, that you might want to use in your own research. And then I'll just sort of list a bunch of open questions that personally I find very interesting and that I think are frontiers in this field. So if you go to our data page over here, you'll see that there's sort of lots of entries. I'm just going to focus on two, which are these restated portfolio estimates, which use this type of methodology that I have described in the lecture today. In particular, there's these two entries here. So one is restatement matrices. So these are the reallocation matrices. I explained to you how we construct them, but here you can get the full set, right, for all asset classes, all investors, all years, and so on. And then the restated bilateral external portfolios are essentially our restatements of what's equivalent to the TIC and CPIS data, going from a residency basis to a nationality basis, tax haven only or full nationality, the way I've described it to you, but you will even find here like our sales-based restatements, which I actually think there's lots of interesting work to be done on. And so this is the structure of the data. If you go and open these files, just want to explain basically what do they look like. You'll see for each year, you'll have a bunch of investor countries, asset classes, corporate bonds, common equities, all bonds. These correspond to the asset classes that get reported in CPIS by each of these countries. And then here is the bilateral, right? So this tells you, for example, this will be US investments in corporate bonds in, well, this row number 2 would be Afghanistan. Maybe not the most interesting, but you've got all the countries here. Position residency is the official residency-based data, which comes from TIC and CPIS, and then you can see all the various restated positions. Tax haven only, full nationality, sales, and so on. So what kind of questions might you want to address, maybe starting from this restated data? So here's just this is my last slide that I'm going to show today. Here's just a map of broad areas that I think are sort of ripe for work. So first, I think the sort of a big question that this entire literature raises is what are the real effects of these financial activities that take place in tax havens in terms of allocations? One basic way to think about it is how do they shape portfolios, right? So when the firms are going and issuing in the tax havens, does it change and how much does it change the nature of the investor base that they're able to access? Answering this in sort of a very careful, credibly identified way is not something that I've necessarily seen. We start doing it a little bit more suggestively in this paper. There's a collaboration for the ECB, but I think there's just a ton of work to be done here. And more broadly, that's a very sort of partial equilibrium question. But you might think about, in general equilibrium, if you put all of this in a model, what's the counterfactual if we were to just shut down these financial activities in tax havens, right? What does that do to global welfare? What does it do in the cross-section of firms? What does it do in distributional terms for different investor sectors and different types of firms? This is all about the allocative effects of tax haven usage by firms. Does it change, does this investment that takes place in tax havens change which firms in the cross-section are able to get capital? I'll give you a hypothesis that you might think about. If going to these tax havens involves a very big fixed cost, right? But it's the only way that firms in some countries like Brazil are able to access foreign capital, then does that mean that you're going to get misallocation because so much of the foreign investment is going to go to the big firms that are actually able to pay this fixed cost? We don't know, but we don't even know if all these facts are best explained by a model that has large fixed costs and large benefits of issuance in tax havens, or small costs and small benefits, which is the next bullet point here. I've told you a little bit about why firms go and borrow in tax havens, but really that's more at a purely anecdotal and descriptive level. And I think will be fantastic to have in the literature is a much more quantitative understanding. So literally, if you wanted to put a dollar term price on it, quantitatively, what are the costs and what are the benefits to firms and to different types of firms of going and raising capital through these offshore financing structures. Similarly, there are going to be implications in terms of public finance. I've told you a little bit about sort of withholding tax, which looks different if I do an issuance domestically versus doing a tax havens. That implies that there are going to be tax revenues, fiscal revenues, that get reallocated from the domestic sovereign, like if an Italian firm issues in the Netherlands, those withholding taxes are not going to be captured by the Italian government, but are going to be captured by the Dutch government or the Irish government. How large is that in terms of overall tax collections? How much should we worry about it if we're thinking about it from the sovereign perspective? And finally, are there implications in terms of financial stability? The fact that all of this investment is taking place through investment vehicles, funds in Luxembourg, in Ireland, in the Cayman Islands, should we worry about it? Maybe because there's laxer regulation, maybe because there's laxer leverage requirements for part of these flows. So I'll just leave you with this. I think it's an enormously interesting area, and I hope that it will inspire some of your work.